Okay, so good morning. I'm Frank Verastro, here with the Energy and National Security Program. I have two responsibilities today. The first is safety, the second is context. So on the safety front, since our safety is the most important to you, I will be your safety officer for the day. In the event an evacuation, which we don't expect, the two most obvious ways to get out, so the way you came in, down the stairs, out the front door, our assembly area is to the right of the Beacon Hotel. The second alternative is behind us, or by the elevator. There's exit signs, take you to the alley, exit on M Street, and then we assemble on the side of National Geographic. This would also be a great time to turn off your phones, because we are webcasting this, and we have a good-sized crowd. On the context side, so it's a great pleasure this morning to have this expert panel reassembled. As you can see, we talk about fundamentals, finance, and sentiment all the time when we deal with oil markets. And going back, some of you joined us back in February when we did a rebalance, which was a bit like, where's Waldo, right? So where are we on the road to rebalance? We always talk about supply, demand. When we look at supply, we include inventory. We include drilled but uncompleted wells. When we look at demand, it's not only the crude oil demand, it's the product demand and the liquids, which frequently escape the detection in some of these systems. But that's what people use. They don't use crude oil except for summer burn and what refineries purchase. So we're going to get into that a little bit today. We'll also talk about the difference between the physical market and the paper market, because what you've seen in terms of sentiment over the last several months is prices have moved sometimes in response to physical activity, sometimes in response to rumor, but also in response to positioning and repositioning. And so we'll talk about that, and I can't think of a better group to discuss those issues. 6 months ago, we actually had this group assembled, and this was prior to the OPEC Algiers meeting, when we talked about what the prospect were for raising prices. And would that be a bit of a trap? If prices got, we talk about the Goldilocks price here, if the price got a little bit too high, you take oil out of inventory, you tease it out of stock, which is what you need for rebalance, but you also encourage new investment. And so a lot of the ability of companies to go out and get capital to drill more wells, if it's quick cycle wells, how fast does that come back into the market? Higher prices then also have a dampening effect on demand to some extent. So where is that balance, and where do you look at that going forward? After the OPEC meeting, we had Secretary General Barkindo here towards the end of the year, and they talked about with the cut what the rebalance would look like into the second quarter of this year. Excuse me. And when we looked at the market rebalance and we looked at the numbers, we didn't see that happening in May, which then makes the situation for the next OPEC meeting even more interesting. How do you enforce discipline, and is it enough to actually bring the market back into rebalance? And if it's not, because you bring on new supply, where do you go next now that you've shot that gun? And Ed will talk a little bit about that. At Zero Week, many of you were down in Houston, so at Zero Week at the beginning of the week, I can tell you that the sentiment at the beginning of the week was almost euphoric. It was much better than it was in past years. The independent producers were all talking their book about how productivity gains and lower costs had made things more attractive economically, and they looked forward to the day when things would come back into balance. By midweek, it had turned. We had Minister Novak on the Russian side not really walk away from the commitment on the Russian side to non-OPEC cuts, but he was really non-committal about how fast that would happen and what it would do to the next rollover. In June, would they continue that? And then we had Minister Al-Fallah from Saudi Arabia, who talked on the one hand about how serious Saudi Arabia was in dealing with this, that they exceeded what their commitment was in terms of cuts, but then they warned that they would not long abide these free riders. 6 months ago, when we assembled this panel, we talked about what the market was going to look like going forward, and what we've actually seen over the last couple of months, if I get this right. So we've seen bears in the market, we've seen bulls in the market, and then when you look at the price of crude oil, and we just took the price from the last time these guys were here, this is WTI, prices haven't changed all that much, but the market dynamics and the situation going forward is phenomenally changed. And we're going to talk about that today. Folks on the panel today, these are some of my favorites that we want to share with you. and they're going to reprise their roles from the earlier session. I'm going to start the order we've reversed after seeing everyone's slide, and we're going to start with Kevin Book. So Kevin is the founder and managing partner for ClearView Energy, but he's also a senior associate here at CSIS. And in that role, since there's no such thing as a free lunch in Washington, he will serve today as both presenter and moderator. He will be followed by Albert Helmig. Albert is CEO of Grey House. He's the former vice chair of the Merck and a third-generation trader, going back to trading pelts in the old days, and I hope some of that comes out. We'll tease that out of Albert. Always a joy to have him here. And our final presenter will be Ed Morse. Ed is the Global Head of Commodities Research at Citigroup. He's the founder of the Citi Commodities Research team. Ed and I, Jack Herman, go back. Our dealings with Ed Morse go back to the 1970s in the Carter administration when we served in government, and then later in the private sector. We were both 12 years old at the time. But he's always provocative and insightful, and this is just a terrific group to make these presentations today. So I hope you will join me, enjoy this group, learn some from it, and at the end of the day, when you realize how much you've gained, I put this together. If you've got any problems, Kevin is the moderator implementing it. So thank you all so very much. And Kevin, the panel is yours.
Thanks, Frank. I guess I'm going to go and get started, and I'll would you like to stand at the podium when you present? I don't want to be atypical. All right, now I will stand at the podium. So, good morning. I believe with a modest amount of coaching, I can figure out technology. Oh, I just go to the next slide. Oh, tricky. No, with even an infinite amount of coaching, I cannot figure out technology. Good morning. I am going to, before I become more moderate, and moderate my message, I'm going to talk about something that, well, there's someone in this room here. Where is he? Well, I won't name him. Maybe you can figure out who he is. There was a Wall Street oil analyst, I recall, back in 2008. I went to go see clients, and they heard from endless numbers of people about the supply crisis confronting the world. $200 a barrel oil, and they said, you know, you sound like somebody who wrote a really good report, because I didn't quite believe that. He's found that demand can't hold up. Demand's the problem. And I said, who is this person who's obviously better than me? Well, here's Adam's report right here, the client said. And sure enough, if you don't pay attention to the demand side of the picture, you're probably missing part of the story. Adam Sminsky, who is, of course, now the Schlesinger chair here and sitting in the audience, sorry to embarrass you, Adam, had a fantastic call thinking about demand while everyone was watching supply. Everyone is still watching supply. I'm not pretending that demand's going to do anything nearly as exciting as it did in the past, but I want to take some of the moments that I have before I assume moderacy to share those thoughts. So let's start with gasoline and global liquids growth. We are looking back at 2016 now with all of the data imperfections that adhere to global oil analysis. The 53% of growth coming from gasoline, from light-duty vehicles mostly, a few boats, a few motorcycles, but mostly folks tooling around on the open road. That's a 16-year high. It's been a long time since it's made up that big a share. And as one of my colleagues at ClearView, Jacques Rousseau, is fond of pointing out, that's a highly concentrated source of demand, and it might give you some reasons to think about how durable it might be. Well, what about the United States as a component? I don't want to pretend that just because I'm standing here in Washington, D.C., the center of the grand universe, the great universe, that it's everything, that the United States is everything, but gosh darn it, the United States is still the biggest petroleum consumer in the world. And 12% of global liquids growth came from U.S. gasoline alone. So it probably deserves some time to think about what's driving American drivers. If you go back to 10 years ago, I like nice round numbers. So on the 5-year correlation, looking back at VMT, vehicle miles traveled, and gasoline consumption relative to the gasoline price in real dollar terms, indexed to 100 for your viewing convenience, you will see that everything rose at once in the 60 months that ended in February of 2007. That's what's known as not feeling so good about inelasticity. And you might say, well, gosh, yeah, the U.S. driver just drives. Does everyone remember this game? This was the game of when will the U.S. economy fail? Because gasoline gets too expensive. And gasoline kept going up, and analysts kept being wrong because people kept driving. Darn it. Well, here we are looking at the 10 years through February of 2017. And what you see happens to be a combination of lying with statistics and reading too much into statistics if you're concluding that the world is completely different. No, the math said it is in fact completely different. The correlation coefficient is almost the complete inverse, negative 0.99 instead of positive 0.9 something. However, it's really that tail end on the right-hand side of the trailing averages that I want you to look at, because that's the part where the gasoline price goes up and VMT consumption go down here in the U.S. Gosh darn it, was that discretionary behavior that we just saw modulated? Are we elastic? I'm not particularly flexible myself, but I think that perhaps we might be. So one way to think about this is to ask, where did we see biggest year-on-year changes over the last 3 in the United States? What were the top 10 big consuming deltas in gasoline terms? What were the bottom 10? Let's try to figure out if there's anything we can look at with the data set we have, which are blocky and lagging and not. So the top 10, you can't really see it on the tiny screen, so I apologize, but we do sell our research to people who like the squinted analysts and scowl. And the flip book is our format, not the big screen. Scowling is much less effective up at a screen. So in any case, the point is that if you look at those 10 states, they are wildly if you look at some basic metrics. So some things that you would expect to be the same across the same 10 states in both categories are in fact the same. So proportionally, gasoline consumption at VMT were about 25 to 27% of the U.S. total, and so was population, which makes a heck of a lot of sense. This is what you would call consistency. So too was the roadway mileage in those states, although that's not a particularly big determinant factor in consumption. And for that matter, so was licensed drivers and registered vehicles, which is a big determining factor in consumption. So you might ask, if everything's the same, why do I care about the top 10 and bottom 10 and contrasting them? And the answer is because some things are very different. I look at the share they made up on a 5-year or 3-year average change in gasoline consumption. They're wildly disproportionate relative to the norms I just showed you. The top 10 accounted for 52% of that 5-year change. The bottom 10 a smidge. You could barely see it. Licensed drivers. Well, there's a slightly disproportionate skew to the top 10, but darn it, look at what's going on in the under 30 crowd. Remember those millennials who aren't supposed to be driving very much? Huh. Surely getting a lot of licenses, though. That's because you still need a license if you're going to borrow or share a car. So that's not a completely antithetical notion in the sharing economy. But look at what else is going on. You're seeing a share of U.S. change in LDVs, light-duty vehicles registered, also wildly disproportionate. Look at all these structural factors. You might say that it's obvious what's going on. There's more people buying cars because there's more people in those top 10 states. Okay. But what about income? Well, in terms of income, they're also somewhat richer, a little bit, at least relative to the past. On a 1-year basis, the top 10 states earn more money. On a 3-year basis, slightly more. Unemployment's a little bit lower. The unemployment change to the downside, a little bit greater. So it must be structural. What you are seeing are the states where things are good and recovering. And that, my friends, is how static analysis fails you. Because yes, those things all contribute. But you have to ask at some point, which is the strongest correlation with consumption of gasoline? If I look over a 60-month series, as I'm fond of doing, I have 60-month series in my dreams, what do I see as the strongest correlation with gasoline consumption? Let's start with the price, because that's the answer, and I'm always supposed to start with the answer. The gray didn't work for some reason. Blame the gremlins that invaded my computer last night, but the right-hand side is still the bottom 10 states, and the left-hand side is the top 10. And I apologize for the color disparity. The red line is the U.S. national average, and what you're looking at is the correlations over the 60-month series between gasoline consumption and price. And lo and behold, they're very strong. In fact, the strongest in the analysis you're about to see. In the top 10 states, not quite as strong relative to the national average in the bottom 10. Yeah, guess what? They're driving more because it's cheap. It looks like discretionary consumption. But you say, you must have considered unemployment. Isn't that a factor? And the answer is yes, it is a factor, but not as strong a factor. Sorry, that doesn't provide the best explanation, just a good supporting explanation. Okay, what about the income story? None of the 20 states I picked actually reached the national average change in per capita state personal income change. Wow. So that wasn't the explanation. Population, also a good explanation, still not the strongest correlation. Guess what, folks? It looks like we're driving more in the United States because the price is lower. We're elastic. Yay! But wait, could there be something inelastic to harm our response to this new low-price environment? Some policy factor, something that changes the structural basis of our consumption? Yes. Yes, and it's not news either, guys. It started in 2012 with the fuel economy and greenhouse gas emission standards imposed and promulgated by the Obama administration. There have now been 8 vintage years, or 7 vintage years, depending on manufacturer, of vehicles compliant with new standards that are targeting considerable reductions in actual gasoline consumption in addition to even greater reductions in greenhouse gas emissions. The black line is historical gasoline consumption. The red line is our, not exactly a base case, it's our keep on truckin' case. What you're looking at here is a 49 basis point per annum, 0.5%, growth in vehicle miles traveled throughout the extent of the extrapolation in the red dashes. So we're trucking. And when I say trucking, I mean trucking. We're buying 65% trucks as light-duty vehicles into the future in this case. And so you might say, well, then consumption's going to go up, 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 up. Oh, no. Because we're throwing so many old, inefficient vehicles off the roads that structurally we're headed for an inversion this year or next in our numbers, in gasoline consumption. The U.S. driver driving the world no longer. But wait. The U.S. government comes rushing back in, and it's just a matter of time before they're going to relent on those CAFE standards, right? There's a new review going on. We've all heard about it. And the model years 2022 to 2025 will change the direction of the curve, the blue dashes. Wrong. Actually, it'll change the slope of the curve, but not the direction. So you'll have a decline that is less dire in gasoline consumption by our models relative to this very trucky case, but it's still to the downside. Okay, you ask. Well, enough about the U.S. Let's look at bubbles. Well, that isn't what you said exactly, but you said let's look at the world, and I'm going to give you bubbles because I don't like maps. What you have are 4 quadrants that represent correlations over a 10-year series between groupings and individual countries. Once I explain it the first time, it'll get easier the next 3 times. Bear with me for the next 30 seconds. The upper left quadrant shows those countries that are negatively correlated with price and positively correlated with GDP. Quadrant 1. So if you think about what it means to be positively correlated with GDP, that's kind of what oil consumption looks like in the world. GDP goes up, you need more of it if you're an industrial economy, mostly. And negatively correlated with price would imply that you'd use even more of it if the price were low, discretionarily. Second quadrant to the right-hand side, upper right, is positively correlated with both, which means that even if the price went up, when your GDP was rising, you needed oil. The lower left-hand side, the lower left-hand side is the negative with price, negative with GDP, which meant that even if your GDP were falling, there might be some price sensitivity if you're in that quadrant. And the lower right-hand side is called sucks to be you. Okay, that's not exactly what it's called, but that's the technical term for it, because you're actually positively correlated with price. You're buying more when the price is rising, and negatively correlated with GDP. You're buying more when your GDP is falling. Sucks to be you. Okay, so the blue bubble is the United States, red bubble is China, the sort of yellowish-orangish one is India, the OECD is the muted gray, and the raging green is the non-OECD. Bubble size corresponds to 10-year average consumption as a share of the global total. And over the 10-year interval through 2000, the world is a quadrant 1 world, with the U.S. smack dab in the middle of GDP-linked consumption. Tells you a lot about who we were. And guess what? As prices were rising in 2005, look at where we're hanging out. We're in quadrant 2 now, along with also most of the world. And the reason is because we're inelastic. So the price rose, and we couldn't do much about it. And so there was a very strong positive correlation with GDP because we were also growing. Good times for everyone until, of course, they ended. In 2010, our big blue bubble, the American driver and all the crude consumption that comes with it, veers, careens back towards the origin and starts going down into quadrant 3, which is the land of price sensitivity, or at least as I'd like to think of it, price sensitivity. Look, by the way, at China, ensconced in the upper right-hand quadrant. Maybe price agnostic and totally GDP linked, or pretty darn close. Does that comport with what you know about how Chinese demand looked back then? Of course it does. That's what they were doing. There were grid issues that required diesel generation as a backup. Things didn't happen if crude wasn't going. There was massive growth and expansion. Those were the raging days of near double-digit futures, right? And now, the 10 years through 2015, the world is dispersed a little bit more, but you can see that the non-OECD is mostly, some of it's in the sucks to be you quadrant, the lower right-hand quadrant 4, but the U.S. is well entrenched right now in what looks like a negative relationship with GDP. Irrespective of GDP, there's still a strong inverse price correlation. Have we become elastic? Well, it pains me to say this after all of this, and before handing off to the next speaker, correlation and causation are still different things. And in this kind of analysis, your grain of salt starts to look like a hunk of ice. However, it is worth considering that, in fact, yes, the change in demand implies a world of price sensitivity that didn't used to be there, which brings us kind of to the point. The point of everything I just showed you is, as a framing context, while we will talk an awful lot about supply and financial markets in the minutes that follow, I don't want us to forget that the world may be fundamentally different in that some of the biggest consumers that still matter to the balances that we're waiting to see rebalance may have become increasingly price sensitive on the demand side. And expectations of just a linear projection forward of an inelastically growing demand may be overly optimistic, and a weaker than expected demand, that too can stave off the rebalancing of the oil market. So with that, I believe it goes next to Ed, who's going to remind everybody why I shouldn't talk about things with bubbles. Right? No?
Thanks very much, Kevin. I just, on the demand side, would like to suggest that things can change in two different directions. We've had China with 20 years of fixed asset investments driving demand for commodities, and particularly petroleum products. For that 20-year period through 2010, for every 1% increase in GDP in China, there was more than a 1% increase in diesel demand. It was very similar to Europe in the 20 years after Reconstruction started post-World War II, similar in the U.S., similar where there was not Reconstruction, but something else going on that I'll speak about in a second, and certainly in Japan. If we kind of look at where fixed asset investment in China now is, based on planning, based on activity, rather than building 226 cities of 1 million people or more, and roads within them and around them, their national security fascination with keeping people apart post Tiananmen Square and not allowing big cities to interconnect with one another, keep people traveling between cities by air rather than through an infrastructure network. The building process now is rail and road transportation systems between cities. So it's sort of like building an interstate highway system. I would, from that, just suggest that the expectations people have, certainly official statistics or policy in China of seeing diesel demand cap out this year and gasoline demand in 2022, I would believe that once you start connecting cities with roads and rail transportation, it'll be used. And when that network gets finished or on the way to it, I suspect there will be a sustained incentive for people to travel by passenger vehicles between cities, and the multiplier effect might be quite great. So I think it's something to look at, and it's a caution on, I think, the temptation we all have to think about the world moving into a period of decline, peaking of gasoline demand. I was not asked to speak about demand. I was tempted to, but I was asked to speak about OPEC and to do an anatomy of the November last December to accelerate the rebalancing of a market that was already taking place. And the title of this presentation is OPEC hoisted by its own petard. It's kind of fun to think about, particularly when you think about the origin of the word petard, which is still in basic French related to passing gas. That certainly is part of the noisy effect of what the French invention of a weapon of war was in the 16th century, which not only was an explosive, but also had a tendency to hurt the person using it as much as it hurted the enemy against which it was aimed. And I think that's a good way to think about what happened through good intentions turning out to be self-defeating. A bunch of countries meeting in Algiers in late September under the pressure of low prices and low revenue, particularly over the course of 2016, which has started with people shorting the market and oil prices falling below $30 a barrel. And a decision was made to to accelerate the rebalancing already underway, to think about where the call on OPEC production was, and they came up with a 750,000 barrel a day target in a range of targets to take crude out of the market, to do it by working between OPEC countries and non-OPEC countries, targeting the finalization of an agreement at an OPEC meeting on November 30th, and to bring the non-OPEC people who were part of that decision and not implement the OPEC decision unless the non-OPEC participants agreed on a meeting that took place on the 10th of December. So that was, aimed at increasing the price of oil. A $10 price increase was the glue that held Saudi Arabia and Russia together, really, because the calculation was a $10 increase in price would have about a 33% impact on Russian government revenues, and for Saudi Arabia it was up to a 25% increase in revenue, something that was euphorically looked at by the end of the year when $58 Brent was achieved. But in the interim, the market behaved the way markets normally behave. If you were a client of Saudi Aramco and were looking at a production cut that was going to be effective on January 1, what would you do? You'd ask for more delivery, particularly thinking about how many days it takes to deliver from the Persian Gulf to the U.S. Gulf Coast. And similarly in China, if you were thinking of a slightly shorter voyage time, what do you do when you're going to be deprived of that stream of water, of oil? So a 750,000 barrel a day problem emerged as a 1,750,000 or 1,800,000 barrel a day problem, because 1 million more barrels a day of oil was hitting the market that was not expected to be in the market, most of it coming from 4 countries, Saudi Arabia, Kuwait, the Emirates, and Russia, which combined had a kind of 1 million barrel a day increase. So the fourth quarter incremental production turned out to be something that was delivered in the first quarter, by its very nature having an impact of delaying whatever the effect of a production cut might be. And where did that go? It mostly went into spare storage capacity within the U.S., where we have the highest frequency data in the world, and coloring what the bare bull factors might be in the market. Now, the question is, was there a problem? And I would suggest that if you look at the growth or non-growth of inventory over the course of 2016 versus where inventory was in 2015 and 2014, there was a big 600 million barrel problem on observed inventory of NGLs products and, of course, crude oil. So a 300 million growth of that set of products from the 3.5 billion in inventory that could be observable in the beginning of 2014, going to 3.8 billion barrels by the start of 2015. The first growth of inventory, of course, coincides with the unconventional oil revolution, and it's worthwhile thinking about that for a second. The high prices of the last decade spurred on a record level of investment in unconventional oil, basically. Oil that had previously not been profitable enough. Actually, you'd lose money developing it, but the high prices stimulated investments in these areas. The investments of the last decade first showed showed a sign of life in 2009 when combined deep water and shale and oil sands production grew by 300,000 barrels a day year on year. And then that increased year after year, sometimes disguised by disruptions in the world. Disruptions in the world were de minimis until February 2011, when Libya went offline, and then in the subsequent years to that, some 3.5 million barrels a day of oil went offline, and the growth of these three unconventional sources was steady, and then explosively growing in 2014, a year that had a lot of things going on in it. But among them was the growth of these three sources of incremental supply, which was 2.4 million barrels a day between the three of them, including natural gas liquids, in addition to things that look like black oil. Another aspect of this was in the period between the fourth quarter of 2013 and the first quarter of 2014, the Atlantic Basin moved from being a deficit environment to being a surplus environment. And that made it difficult for kind of the middle of a world in a flat earth world, which has the Middle East, Central Asia, and Western Siberia kind of stacked up on top of each other. That was a supply surplus environment. The Atlantic Basin to the left on a flat map with them in the center was deficit. The Pacific Basin to the right was a deficit. And all of a sudden, the Atlantic Basin was closed off. And I would suggest permanently closed off, which meant any incremental production coming out of that middle had to be targeting growth in South Asia and East Asia. So we had a Saudi response to a losing market share at the end of 2014, which lifted, combined with this spurt of growth in the unconventional oil players, inventories by 300 million barrels. And then 2018 happens. We have 650,000 barrels a day of incremental growth in Iraq. We have Saudi Arabia putting more oil in the market, a tailing off but still positive growth from the unconventionals until that peaked kind of in the middle of the year. But yet another 300 million barrels of incremental growth. And then look at 2016. Notwithstanding all other things, Iranian production adding 800,000 barrels a day, no growth of inventory to speak of. Canadian fires shutting in Canadian production for a couple of months, coming back in the second half of the year, and inventories are drawing. So I would suggest that there was no problem other than a desire of a bunch of countries to make up more revenue more quickly than they otherwise might have, and that had they not taken action, the problem would be solving in a much more orderly way than the problem that emerged. A solution, therefore, of an OPEC cut was creating its own problems in multiple ways. This is a look at the forward curve when we met to talk about these things in the market a half a year ago, and here's the forward curve for Brent at the end of the year. In full contango through that year, and what was one of the things that happened as a result of that? Oil moved to more expensive places to store it. The world didn't run out of storage space. The world moved to store crude oil and petroleum products on ships. And that was sustained because the carry was covered by the forward curve, made it profitable to store oil at sea. And we had a lifting up of the forward curve. And that was good news for the producers who could see a $45 price turn into a $58 price. But it had two ancillary impacts. One, it made it unprofitable by the end of the year to store oil in floating storage. And we had a significant release of that, as I'll speak to in a minute. And then we had it profitable for producing companies to hedge forward. They had been under-hedged, and they forward, their hedging level increase in that quarter was probably, on the whole, a record for the world. Not only were U.S. producers hedging forward again, so were Canadian producers, so were a whole new set of producers in Australia, in China, in other parts of the world that had never hedged before, and they too hedged forward, suggesting that the double problem for the organizers of the production cut was that they not only were creating a problem for themselves in the near term, but they were creating a problem for themselves later on given the amount of hedging locked in, that led the producers in the Permian Basin alone to have forward guidance for 2017 that they alone would be increasing production by 1 million barrels a day. We had the float driving down. That meant floating inventory of both products and crude, about 60 million barrels worth. Left floating storage at sea and moved either for consumption on land or further fed into the storage growth around the world, some parts of the Mediterranean, some parts mostly in the U.S. Gulf Coast. The quarterly change in hedging was quite spectacular. We think added to the coverage by the end of the year for 2017 production. Another layer was added to that in the first quarter. We don't have reporting on it, but it may well be that 70% of the projected growth of U.S. production in 2017 has been covered by these hedges. Entered at this point the financial markets, and that was something that we talked about a lot 6 months ago. On the slide in the upper left, you can see the growth of futures and options in CME NYMEX traded crude and ICE traded crude. Relentless growth in the period from 2014 to 2 days ago. That growth for futures was 49%, and that growth for options was 39%. And it stimulated, along with some other things, a lot of incremental trading activity. And we had, over the course of this year, with red line looking at the net length, a lot of fickle changes among the trading community. That net length definition is hard to really pin down. It's a little bit sloppy on the CFTC's part, but at least we have notionally that what was kind of an average norm of 400 million barrels worth of oil stored in net length in the futures markets, we had a significant uprising in that. An uplift that started particularly right after the November 30th OPEC meeting, where it was kind of low with people doubting that they were going to actually have an agreement. And then we had this massive growth such that by CERAWeek, there were 951 million barrels worth of net length. As Frank pointed out in his introductory remarks, those of us who have been having systematic conversations with the Secretary General of OPEC and people around him, we suggested that that was going to lead to tears at some point, because you can't have that level of length being sustainable for a really long period of time. It was hard to know what would be the trigger of the sell-off or the timing of the sell-off. And as Frank indicated, it actually was sourced in CERAWeek with euphoria at the beginning of it, and then a notable difference between the Russian oil minister and the Saudi energy minister being read by the market as very bearish, because there was no sign that the major participants in the market were really willing to have an extension of the cut through the second half of the year. And the problem they created meant that they had to have a cut that was projected through the second half of the year if the unbalancing of the market that they unwittingly created was to get resolved. Crude net length and the price of oil had been, over time, really neatly correlated with one another. There was a period in 2015 when one was falling faster than the other. But if you look at the price of oil in the fourth quarter and the first quarter of the year, it got unhinged from the net length, which grew systemically grew, even though oil prices had turned out to stabilize. So it was clear that there was a problem in the market. Obviously, financial flows, politics, and the supply and demand balances play off one against another. There's very little sign to indicate that they won't. And I think that's going to be kind of a topic of conversation. Intriguingly, 2014 was a year in which multiple things happened. It was a year of massive reduction in capital spending because of the decline in prices. At the second half of the year, it was a year in which Dodd-Frank was implemented. It was a year in which the deferred part of trading saw liquidity drop because of Dodd-Frank. It was a year at the beginning of which, when a very stable forward curve that was filled with liquidity, that was associated with banks like the one I work for, being able to have an inventory of derivatives and then no longer having an inventory of derivatives, drying out the liquidity in the deferred curve so that speculators entering the market, as they did at the beginning of 2014, a year when the Atlantic Basin became a surplus basin. It was a year in which ISIS taking over the Sunni Triangle in Iraq and Russia taking over Crimea and increasing its military presence in eastern Ukraine allowed speculators to destabilize the forward curve, which had been perfectly flat for Brent at $90 plus or minus 2 from the middle of 2009 through the first quarter of 2014. So we have a lot of things to talk about with respect to the interplay among these things, and I hope we'll have an opportunity to discuss that after the next presentation. Thanks very much. That's all to say, don't believe anything I said.
Banks have to disclose all that stuff. Well, good morning, everyone. Thanks for coming. So as Frank mentioned, I come a little bit from the other part of the world. Both my grandfathers were traders, and actually futures traders in the early days, and my father also. So I come from the commodity merchant business, basically, and then went to Wall Street early before there was a CFTC, just to show you how old that is. And then went back and ran a global merchant company. We operated on 5 continents at that time. And then went back to Wall Street and went to the floor. I was actually one of those nuts screaming and shouting on the floor for years. And at one point in a partnership in energy, we were the largest floor brokers in New York, primarily all commercial book, so it was the industry. I always try to step on people to talk about speculation because everybody speculates. So I prefer to talk about it as non-commercial and commercial. Okay, so just to sort of warm up, I thought I'd give you a little bit about what futures markets are, how they got there, and what they're really trying to achieve. So the first thing is it's a risk transfer. You know, simplicity is where fear meets greed. I think it's going down, I want to sell it to you. You think it's going up, you buy it from me. So it's a risk transfer. You know, I'm getting flat, you're getting long. You know, you're getting flat, I'm getting short. Okay? So futures markets are price discovery. It's visible. It's on everybody's screen now. You know, I remember the days when it was chalkboards, before it went to flip boards, before it went on to Reuters, Bloomberg, etc. So it's price discovery. Everybody can see it every moment of the day, basically. So futures markets provide what we call TLC from an exchange point of view, which is transparency, liquidity, and clearing. So transparent prices, you can see it every moment. Liquidity, there's a vast pool of liquidity, you know, in all commodities, but particularly in energy. Energy is the largest of the commodity groups. And then clearing, people throw around a little bit, but it's basically guaranteed financial performance. So every day the clearinghouse starts 0. If you're up $1,000 and I'm down, we send it to the clearinghouse. Everybody replenishes the guarantee fund, simplistically. Futures are standardized contracts. You know, all terms and conditions except for price are standardized. And really in the WTI contract, which is slightly different than Brent, futures expire into a cash position. It's a physical position in WTI, while Brent expires into a financial position. There's a little nuance as to why that happened. Brent actually started originally as a physical delivery market, but couldn't work. So as I said, contract design, you know, it's a specific size. It's 1,000 barrels per contract. And the design, you know, I used to run that at NYMEX. You try to get the smallest notional value where you have both commercial and non-commercials meet. You know, 1,000 barrels isn't a lot for a major oil company or a large merchant, but that's where you get a non-commercial who's willing to spend or participate in that. Okay, specific location in the case of WTI, it's a Cushing delivery. And a specific expiration month. Oil is really the only thing that trades every calendar month. Metals are cycles, ags are cycles. And the thing that's missing here is the specifications. So while they call it WTI, there's actually about 15 grades of oil deliverable against that contract. Okay, and in the fourth bullet point, there's 200 grades of crude oil, basically, that go to 700 refiners. So crude is not crude. It's not, you know, gold. There's different grades, sweet, sour, location, etc. So physicals trade at a premium, par, or discount to the futures price. And that's where the merchants are arbitraging the difference. And because the futures position expire into a cash position or a physical position, the commercials are the one that guarantee the convergence of futures to cash. If I can buy crude oil at $50 and sell it to those nuts in New York at 51, I sell it. And when they can't eat anymore at 51, they sell it back to me at 50. So that's the arbitrage function of commodity merchants. So Ed mentioned this. This is a different way to look at open interest. So a little history. So crude oil started to trade in the United States in 1983 as WTI. And believe me, the commercials wanted nothing to do with that. They had their own game. Who wants to trade with these crazy guys in New York? Okay? So in 1985, when crude oil did its first dive to $10, and the cash market basically froze, or certain players froze, if you will, for financial instability. And all of a sudden, that guy in New York was paying more than I could sell it for in Texas. So I started to trade that, and open interest doubled. 87, there was, you know, the Black Monday when the stock market went down 22%, and certain financial instruments fractured, and open interest again pumped up because it was guaranteed financial performance. I didn't have to worry about my counterparty taking the product or paying me for the product. So I went into a guaranteed financial support system. 91, the Gulf War, same issue. The cash market sort of froze. Futures was a viable alternative. Futures expire into cash. Open interest doubled again. 97, oil goes to $10. Same thing, it goes up. Record volume, just to show you, record volume in NYMEX in 91 during the first Gulf War broke for the first time 100,000 lots. You know, we trade 1.3 million today on average. I actually traded in, we had a very large spread book. We'll talk about forwards in a moment. But basically what you've seen happen since 10 is you've seen a doubling of open interest. That's really remarkable. Okay, and if you look at really the last 12 to 15 months, from 4 million lots to 5 million lots, this is WTI and Brent combined, by the way, okay, that's 1 billion barrels of oil. That's a 25% increase in the open interest from a very large number. That is huge, okay? So Ed mentioned this. So if you look at the pink and the blue, you know, the non-commercials are the long. What's not in here is commercial longs, which are refiners now. Since in the United States, the vast majority of refining capacity is owned by independents. They do not have a oil stream, so they buy futures to lock in prices. But I'm just trying to demonstrate long and shorts. So in this chart, basically when you see the $26 low of January of last year, 26.20, which was there for a blink, okay? The trade is sort of the same profile, producer hedging, if you will, out forward, and the non-commercials start to add length. The old saying in the physical market, when nobody wants it, take some, and when everybody wants it, give them some, okay? And that's what you see at the end. So if you think about the, very simplistically, if you think about the increase of open interest from 4 to 5 million lots, 1 billion barrels, and the huge increase in producer or commercial hedging, What basically happened was the commercial market sold 1 billion barrels of oil to the non-commercial market. Okay, and I'll demonstrate that in the spread formation at the moment. But that's the risk transfer profile. Okay, and it happened along the whole length of the curve. Now the spikes you see in various spots here, the way the financial market interacts with the futures market is if I'm selling or buying the 2017 strip, which is an average price of every month, or the 2008, the way the financial market intersects with the cash market, they basically make quarterly payments, semi-annual payments, or annual payments. So the big spikes are the December contract, which is the average of the year scenario. But as you can see, it happened along the whole length of the curve. So 60% of the open interest and 60 to 70% of the volume is in the first 120 days of a futures market. Okay? You don't have any price risk until the seller prices it to you. If I'm buying 1 million barrels of oil from OPEC a day, I have no price exposure until they price it, whether that's the 5 days of shipping, the monthly average, etc. So when you transfer the price risk to me, and I have it unsold, I can be one of the commodity merchants, a Vitol, Glencore, Mercuria, Trafigura, or somebody else. The IOCs participate in this market too, is I shed that price risk until I have it sold, and then I reverse the position, take the futures off, and normally trade it back to my normal cash or physical merchant. Okay, Ed mentioned things about curves. Okay, so here's a pretty, a lot of colored lines, but just to show you how the curves work. Okay, so the customers I used to represent on the floor in the commercial area, merchants are only worried about really one thing. Merchants are not really long or short the market. They're long and short time and location. Whether you're talking about trying to empty the Atlantic basin of supply and shift it to Asia, it's a voyage, it's a boat. I have stuff in Singapore, I don't have stuff in Singapore. The Atlantic arb is open, the Asia arb is open, the Asia arb is closed, the Atlantic arb is closed. So it's really just a rebalancing in the global flows. Okay? So I made one of these speeches in 2013, 2014 in London. And oil basically was $100, $110, no matter whether you're talking WTI or Brent. And, in one of those conversations, somebody was like, oh, well, the CEO of one of the majors sat there and said basically, it's going to cost $90 to $100 to get this oil out of the ground. And how are we going to get to 100 million barrels of production a day because the world's growing, et cetera, et cetera. And I was like, I hear you, but somebody is selling 85s and 70s. I hear you think it's going to 100, and that's what it takes to go out of the ground, but somebody is selling this. So the part I always try to represent is, I came to Wall Street in the middle 70s with a couple fancy economic degrees, and everything was fundamentals to me, and I got hammered. Okay, and the clients I was representing were, my position was a little bit too fundamental. So Reuters used to be on my desk on a paper roll, and that was it. Okay? There's so much data and information today, you cannot digest it. What is the most important thing? They talk about big data, high frequency trading, all that other stuff. I don't know how you figure it out. So the only thing that matters to me is price, where people actually are voting with their pocketbooks. Everybody else is a weatherman to me. Oil's going to $200, it's going to zero. Very rarely does it go to the extremes. So the only people I try to watch are the people who are actually voting with their pocketbook. And that's what the curve is. So when we do the dive to under $30, the market goes into a steep contango. So just to do a little, so contango is cash and carry, okay? Where you pay for storage, insurance, okay, to put it in the tank. So today, the market's representing that cash and carries are 50 cents a barrel per month. At $27, that stuff was trading at $1.20 in a overly stressed condition. And that's when you get this huge stock build. The market was paying merchants to store the oil at above cash and carry, so then they clip the location and time premium. So you need it tomorrow because you're not hedging anything, and I'll sell you Singapore at $3 over Brent, or I'll sell you something in the basin $1 over WTI. So the market paid the merchants to store. I'll demonstrate that in another slide here. So what I said earlier was, so here are these non-commercial speculators, if you will, going, oh, OPEC's cutting, demand is better or it's going to grow, the world economy's coming back, you know, blah, 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 blah. And they're like, buy it. And they take the curve flat, what you saw in January, basically. Okay? And the merchants are like, you're going to pay me a premium to take it out of storage. Here's the oil. Okay? So when people are going, when we were here last time, and one of the economists on the panel was going, you know, oil's going to trade $65 this year. And that's going to be the third and fourth quarter average. And of course, as you can tell, as a floor trader, I always have an opinion about something. And I go, you know, I hear you, but, you know, somebody is selling 53s and 55s like no tomorrow. And that's the huge open interest increase from the non-commercials selling that thing. So why does a producer sell forward? Okay, particularly when oil has been $30. I sell it forward because the banker, the PE firm, whatever you want to call it, goes, yeah, I'll lend you $50 million or $100 million, but I don't want that oil as collateral. You need to forward sell that. You know, banks lend money. They don't lend oil. Okay, so I want you to sell hedge 60% of your production to cover the performance on the note, or I'm not giving you a dime. So they're selling $53 to $55 in 2000 and 2008 strips, or 17 and 18 strips, and they're happy. Depending on who you talk to again, and this is where price comes in, some people are taking oil out of West Texas between $25 and $35 a barrel. Having lived in Texas at one time for a long amount of time, believe me, if you're showing me $10 of profit in crude oil, I don't care what OPEC is doing or China's doing. I'm taking my $10 right away, and I'll sell you all I can sell you. So these instruments get pretty complicated. So there's just outright selling of futures, and I'll argue or I'll say that, you know, some people hedge just the revenue guarantee to service the debt. And then, well, you know, if you're a PE firm, you go, well, you know, we need some other crazy downside protection. Let's buy $40 puts. So if the world ends tomorrow, at least we got some more cash stream, we get a little bit more runway, and we can survive. Okay, so when you look at futures open interest, that's not all the financial structures in hedging. Options are typically 2 to 3 times the futures open interest, while only 15 or 20% of the volume. Believe me, there's a lot of guys who have bought insurance below $45 and $40, you know, in a worst case scenario. So this comes back to the forward curve a little bit. And so I have some date issues, okay? But on the drop to $26, and the market is paying for storage. The market's paying you, the merchant, to store. Non-commercials cannot get tankage. You cannot rent tankage in Cushing unless you're a commercial player. They're not selling it to hedge funds or private individuals. Okay, so when the market pays you for storage, the storage number goes to 71 days of coverage. That's a lot of coverage. Okay, when I first started to trade oil, briefly in '85, but really in '90 as a broker for commercials, you know, we talked about coverage as 53 to 55 days. Okay, so the point basically here is I think there's a slight distortion on how people think of oil stocks. Okay, so yeah, we're at record highs, and I get that, but you know, there's more infrastructure built. You know, some people represent there's 6 billion barrels of oil in transmission. boats, pipelines, refining capacity, et cetera. So the overstock situation, I think, is slightly exaggerated. But when the forward curve lets the merchants, and this is IOCs, middle merchants, and small merchants, pays you to store, they put it in storage. So when the curve gets flat at the very end of the right-hand curve here, you know what we saw in January, the merchants give you the oil back, okay, and it comes down to 63, 67 days. So I don't think we have as much coverage as oversupply as everybody thinks globally. What you're really seeing, I think, is you're seeing a shift of location. So as Ed mentioned, you know, or Kevin here is, you know, the advantage of the U.S. numbers is it's got a lot of data points. You go east of the Suez and say China is doing this for strategic reserves or not. Once that oil goes east of the Suez, that is not a retradable barrel. It'll come out the back end as a product, versus in the U.S., you pay me a premium for the crude I have in cash and carry, I give you the crude back. So we've basically seen a shift over the last 8 to 10 years of the geographic economic map to Asia. You know, China consumes 10 million barrels of oil a day, up from 5, which was their own domestic production. And the other parts, you know, India, et cetera. But we basically have seen a build of stocks in Asia, which I'll argue is not totally transparent. Okay? So in closing, you know, what is rebalancing and when does rebalancing happen? Okay? Well, it's when the merchants sell somebody this oil and they take it out, not just a paper barrel. So what you just recently saw, we got locked into basically a $4 or $5 range between $50 and $55. The non-commercials are very sensitive to technical analysis. And the market got a little tired up there. The moving averages rolled over, okay, which is a trigger for certain portfolio non-commercials that they need to lighten up their long positions and or get short. So what do they do with this billion barrels of paper when the market tells them don't hold that much? They have to turn around and sell it to the commercials again. So what you just saw in WTI, so that 1 month roll of the April to May contract in January was 25 to 30 cents a barrel. That does not cover storage. But when the non-commercial gives up that position, the last 2 weeks of the contract expiration, which is when the big boys are playing in it, the guys who have the money, the storage, and the oil, and the non-commercials and the paper market goes what I call to whom day. Who are you going to sell that to? You have to sell it to the commercial. So the last 3 days, or I'm sorry, the fourth to second day out before expiration, the cash and carry went out to 50 cents. And the commercials are taking it back from you at $49, $48, $47 because the market's paying to store the oil. The last day of trading in WTI, which is always a nightmare, I used to love that. I handle a very big book on the last days because it's only 5 or 6 guys that can really trade that. The last day, it traded 90 cents, the spread between the 2 months. Now, another way to look at that is now, so WTI simplistically is trading about 270, 290 a barrel under Brent. That becomes an exportable barrel to Asia. When that spread was $2, because the non-commercials were bidding up the outright market, that spread was into $2. That's not an exportable barrel to Asia. So the cash market at the end, the fundamentals, the commercials really call the tune. And when the paper market has to get out, they have to get out against the commercial market. So that's how it all works. The futures converge into cash. The physical guys actually make it work. We're moving millions of barrels a day. I mean, some of the commodity merchants, if you take a Vitol, a Glencore, a Mercury, a Trafigura, depending on what you believe and what you don't believe, they have basically 10 to 15 million barrels a day they're trading in physical oil. They're trading 10 to 15% of the production. They're the guys who really make it happen, where the rubber meets the road. So with that, I think we're going to open up to questions, right?
Thank you, Albert and Ed. I'm going to... That was a lot of information, and I think we have such a big crowd here. I want to get to questions very quickly, so I don't want to dwell on too many moderator prerogative questions. But just before we go to those questions, it does sound like, Ed, you said OPEC didn't have to cut anything because the market was going to solve itself, as it turned out, because of events that transpired. Canadian file. Your round trip on inventories looked an awful lot like Frank's round trip on price. And what I think you may have just said, Albert, is that the storage levels that everyone was talking about that were just immense were probably not that anomalous. Yes. We're looking at a certain number of metrics over and over again and pretending that we understand what a new normal is. Are we in a world of new normals, of new inventory forward demand cover, of new break-even prices, or is this the same old normal all over again? Either one of you can go first.
Oh, I'm happy to follow up on what Albert said, because I think he hit the nail on the head with respect to one deceptive aspect of what the producers claimed to be after, which was a reduction of inventory to the 5-year average starting at a point in history going back. And that's just ridiculous because of some of the reasons that Albert put forward. And it's one of the factors that got themselves in trouble. So why should that 5-year average be meaningful in a world of a couple of things? Actually 3 that I'd like to point out to fill in some of the blanks that Albert left dangling. One, he didn't leave dangling, which is the build out of logistic infrastructure around the world. You need more storage, you need more pipelines, and you can actually put numbers around them to estimate. You get 1 million barrels a day, let's say hypothetically, in China, and that 1 million barrels a day has a requirement of the amount of oil in storage. It could be 25 or 30 days of forward cover. You've got pipelines to build. Maybe on average that's another 5 million barrels of oil to put in kind of dead space. It's logistics supply. It's not real demand, it's apparent demand, and that storage is not going to be released. You have U.S. Gulf Coast refiners that have had a diet of essentially, let's say, 50-50 imported crude and domestic crude. They think of holding 25 days of forward demand cover in their storage. They only report a fraction of that to API and to EIA. They don't report oil in transit at sea. And you move to a point where you have a chunk of oil in transit at sea that's now going to be moving to oil on land in storage. So that's another deceptive factor in looking at whatever that 5-year average is. And that's something new. And it's something new because it's associated with the reduction in independence over time of the U.S. system on foreign imported oil or product. And that means it's going to be a suggested product bill, too. If the U.S. has moved in a few years from being, let's say, a 4.5 million barrel net importer of product to a 4.5 million barrel net exporter of product. And then there's a third factor on the U.S. side, all other things being constant, and that is the U.S. was at one point not so long ago a net importer of NGLs, and now it is the largest LPG exporter in the world. And that also requires days of forward demand cover in the system. So it might behoove them to think about what the real target ought to be on the inventory side. And no matter how you look at it, it's going to be a good, I'd suggest, 120 million barrels higher than the targeted number that they've been aiming at. And they have to pretend that they're not looking at a price for whatever historical reason in OPEC. They're pointing out an inventory level, and that inventory level is a moving target that they haven't digested.
products and crude, if you will, that has to find a new home. That's a huge swing. And I'll argue that that whole swing is east of Suez into the Asian market. But the U.S. is the swing producer, the swing merchant, the swing refiner. To give you another example, and they have to build all this capacity to export products and to run these refineries at these levels. Refining costs in the United States today, it costs you $2.50 a barrel to crack a barrel of oil in the States. 20 years ago, it was $4. It was about $3.75 in Europe at the time, and it was $2.10 to $2.50 in Asia. Today, it's $4 in Asia, it's $4 in Europe, and it's $2.50 here. And the reason it's $2.50 here is really natural gas. Okay? So the U.S. actually has the best refining cost structure in the world. That's why we're exporting it like no tomorrow. The weakest part of the refinery puzzle basically is the European refinery puzzle.
I'd like to add one other factor, that sort of a dirty factor. As Albert mentioned, half of the production of OPEC, at least, is traded by a handful of companies. And those handful of companies have younger guys than we who are involved in trading activity, and they have an incentive to make a profit on what they do. So it is logical, and it actually happens, but we don't know what the number is, that the storage play, the carry trade, has been so profitable that when a company buys storage capacity or leases it, the controls over what is in the tank get lost. So a DSW problem emerges when when you're putting in light and heavy, sweet and sour, and you don't know what the average barrel is in the tank, that nobody wants it. And there's a lot of trade among the young guys in those companies who want to prolong their P&L and not actually test what the marking to market may be of those barrels. They can't sell it to anybody except at a steep discount. If they sell it at a steep discount, their P&L really is wrecked. So we don't know what's going to happen on the day of reckoning. We don't know how much is in, I'll give you one example of third-party storage, 50 million barrels of oil in Sedona Bay in South Africa, which had no oil in storage except some logistics supply in 2014, now is at top full storage of 50 million barrels, basically, and nobody knows what's in any of those storage facilities. Nobody wants to test what's in those storage facilities.
Except the merchant who's got it.
And the merchant who's got it knows that it's crap.
Correct.
So, so that too is a factor in why the new normal on inventory is going to, lag a sell-off for some considerable period of time.
I hope everyone in the audience is paying attention to what Ed Morse from Wall Street and Albert Helmig from the market are saying about what the market is doing right now with regard to what numbers it sees today and how different they may be in reality from the numbers of the future and going on. Albert, you had one final comment?
Yeah, I want to make a stress comment to you, okay? So I gave you an example when the cash market freezes, people run into futures, okay? So I've been involved in a couple of very big liquidations on Wall Street. I don't know if anybody remembers Drexel Burnham Lambert, who turned into the largest commodity merchant in the world and basically folded within 3 days in a liquidity scare. Everybody goes busted for the same reason, by the way. A loss of credibility creates a liquidity scare. Nobody takes your credit, nobody trusts you, they want 100% of the money up right away. It now typically in America also ends in litigation, which has another feature to it. But trading is part science, part art. And as Ed mentioned, there's a lot of younger guys in the room now, and it's all screens. There's not a lot of communication information flow. They think there's large value in holding that proprietary information to themselves and doesn't get out. So when a market moves one standard deviation away from the norm, the science pretty well can handle that. You can hedge that away. 2 standard deviations, okay, you can still probably do that if your risk model, and believe me, all the banks and the trading companies run very sophisticated risk models now. When it moves past the second deviation, it's art. That's when the young guy sitting on the desk freeze. It's down $1. Well, we're not selling it there. Okay, well, now it's down $2. Now what are you going to do? And about 30 minutes or 2 days later, the treasurer walks in and tells you what to do. Okay? So this is one of the reasons why you've seen this large increase in risk management they talk about, and risk transfer and price transfer, et cetera. When oil, any commodity, so we basically have had a commodity boom and a collapse. They go down 3 times faster than they go up. Commodity bull cycles last between 11 and 17 years, you know, la-di-da-di-da-di-da-di-da. Okay? But when they drop 50%, which seemed like overnight in the oil business, you know, the guy sitting next to you is the treasurer of the company or the bank. And he's watching every trade you do, and your risk profile materially changes. And that's where you get, you know, $26 oil and $2 cash and carries when it costs you 50 cents to cash and carry it. So that's just amplifying. Us old guys think these young guys sound great until something goes a little haywire, and then they don't come to work for a couple days. I've actually had guys working for me that did that. You disappear. What we used to call, they put the trades in the drawer for a couple days. It's harder to do that, but they still do that.
The age of paper speaks. So there are several rules. One, please, when you ask questions. Second, please state where you're from and who you are. And third, as this is being webcast, I believe there are microphones, yes? Please wait for the microphone so that your question could be heard by the audience outside this room as well. With all that by way of preface, who would like to ask the first question? Don't all raise your hands at once. Jamie.
Jamie Webster from BCG Center for Energy Impact. I'm just wondering, gentlemen, you guys have a lot of experience and have seen things over the last several decades. Some of the stuff, and I think Ed alluded to it, and Albert, I think you might have as well, is do you see any difference or any way that the market needs to be re-looked at from a financial standpoint as you have the rise of kind of algorithmic and black box trading, and then at the other side, the enormous rise of the ETFs, anything from you can get a double short to a double long to a triple short to a triple long. Is that, how are you thinking about that, if any
Well,
changes?
this is a great question because we probably slightly disagree on this. Go ahead.
Right.
Do you want me to start or you want to start?
Well, on the first part of the question,
Microphone.
I abstain from answering any part of the first part of the question.
Oh, okay, yeah, for the obvious reasons. Okay, high frequency trading, black box, artificial intelligence, algo trading, only affects the first 60 to 90 days of trading, because that's where the big liquidity is, et cetera. So to give an example, I want to say the May futures contract now has 400,000 lots of open interest, and it trades that volume every day. Okay, that's where they are. Okay, it's, from my perspective, they just turned what was the floor local trader to the electronic local trader. Okay, and all that trader is interested in is seeing order flow. So you can buy from the exchanges, ICE and CME, you know, depending on how much you spend on your terminal a month, you can see the best 10 bids and offers on the screen. So you can see when there's 10,000 lots bid for and there's 2,000 lots offered, and it takes out a double top or a moving average, or if it closes up here, so it's all technical analysis. So that's what the artificial intelligence is really doing. That's what the high frequency traders are doing. Okay, so to give you a crazy example, and this has been true for like 30 years, 61% of the time, okay, the opening range is the high or the low for the day. It's almost unbelievable, okay? If a market closes on its lows, it typically opens lower. If it opens on its highs, it typically opens higher. You know, oil prices today, I don't know if anybody's watching, is a great example. You know, closed on its highs yesterday, opened slightly lower, took out the opening range, and is trading higher. That's all the high-frequency algo guys are doing. But they have no effect really on what I'll call the 120-day curve, because they can't trade the physical market spread against the paper spread. Just one more, ETFs, okay? So, you know, everybody likes oil action. You know, it moves, it's great. So ETFs simplistically are not all non-commercials are qualified to trade commodity or futures products. Some can only trade equity. So an ETF is really just the futures price turned into a stock. So when you buy and sell the ETF to me, I'm a high-frequency market maker, trader, I turn around, the price I'm giving you in the ETF is the price of the futures market. So that's all our back end. That's all.
So if there's a point of slight disagreement, it's on this issue. This is a mapping of, I think, all of the publicly traded oil-backed ETFs, which is about, well, it's multifold, whatever is in the Bloomberg index of oil-priced ETFs. Some of them are highly levered, so you can have 3 times levered longs, 3 times levered shorts. They represented 2 to 3% of the market going into January 2014. This is an extension of exactly the same graph I used 6 months ago when we had a similar conversation. On the right is a measurement of the percentage of open interest of these ETFs combined of the first 2 prompt months of the NYMEX contract. And you can see they did nothing at the beginning, but you get to levels in 2015 and 2016 where it's 40%, 50% of the open interest in the real prompt part of the forward curve. And to try to say that it has no impact on the market, I think, is not a logical position to take. Because it is a demand for the forward contract going forward. It's the same function as oil indexed or commodity indexed. Long-only products have its demand for whatever the role is going to be. And you have a period of time when it's systemically growing, it's going to increase the demand for the prompt contract. And if it's that level of size, it has to have an impact. So we argued in 2015 when that open interest was rising rather dramatically that there was froth in the market that was moving against where the supply and demand fundamentals were going. It was, to me, really easy in February and March of 2015 to say the price of oil is going down to $30. Now, I didn't mean really $30, but it was an untenable supply-demand situation. It had to go down, and we used $30 just to dramatically indicate where that market was going to go. If you look at when the market went to $30, something happened that I had not anticipated. I don't think anyone anticipated, but there were 3 significant short positioning in the market. One of them based on what both Albert and I talked about earlier, the belief that as on-land storage reached capacity levels, you had to go to more expensive levels and the forward curve would have to drop. Secondly, December, January 15-16, Iran is coming back in the market. People thought 1 million barrels a day. We're going to really swamp the supply-demand balance, and price of oil has to go down. And then in that winter, there was great uncertainty at the macro level in the market that there was going to be a collapse in the Chinese economy with international consequences. So, a triple witching set of factors leading to that. And at that time, a number of triply leveraged short ETFs were put in the market, became very popular. That's where the open interest went down. There was a sell-off subsequent to our meeting here last fall before the September 28th meeting. That drop in ETF holdings is hard to really, in our judgment, try to figure out the factors behind it. And it preceded by 4 months the sell-off that happened in March. And in thinking about that, going back to the rise in length that took place subsequent to the OPEC meeting, it's not just that the oil market itself was part of this. There were other factors at work, and I'd like to suggest that there are 2 factors that may have significantly caused the kind of minimum or average length in the market to go up. One of them was the reflation trade, maybe a little bit premature, but certainly around the time of the election, even starting before it, when people thought the rates were going to go up, there was a significant rotation out of bond holdings by large institutions into commodities and into equities. Now there's a multiple trillion-dollar bond market, rotation out of it, going into an oil or commodity sector that has much less than 1 trillion, let alone multiple trillions in assets under management. That rotation, I think, is much more permanent than or stable than what the more fickle in and out of the market had been before the fourth quarter of last year. And then on top of that, 2016 was the first year in the decade in which the pool of contracts that are devoted to passive holders of commodity indices actually grew. So two things happened in 2016 for the first time in this decade. One, oil and other commodity prices ended the year higher than they started the year. The forward curves flattened out, and more money came in rather than going out. Every year from the start of the decade, capital came out of the market, and now capital is going into the market. And even with the sell-off that took place in March, capital continued to go into the commodity market. So I suggest that also has an impact on prices and an impact on where the underlying length will be to support prices going forward.
With this esteemed panel, we don't get short answers. We are, however, running short of time. I want to try to take a couple of questions at once. I saw Bill in the back. Maybe if you want to go first, and then Frank, did you have one as well? And is there another one we can try to do a triple batch, triple short question, if you will?
Thank you. Bill Murray with Real Clear Energy. You were mentioning, the panel was mentioning how things have changed in the last 18 months and how much of the arbitrage was allowing U.S. crude to go to Asia. But 18 months ago, it was actually illegal for U.S. crude to go to Asia because the ban wasn't lifted until the beginning of 2016. And I'm just wondering, how does the export ban being lifted here in the U.S., how has it influenced any of these relationships between prices and margins?
Okay, then move ahead. Clear the path.
My position on that has always been, we've been exporting crude forever. We just call it products. Now you're allowed to export crude, and depending on who you're talking about we're not, so physical crude exports have been between 500 and 1.2 million a day, okay? I don't see that number materially growing. It's almost on a boat situation. But, we've been exporting, 3.5 to 4 million barrels of products a day, which is de facto crude. And that's part of the advantage the refinery capacity in the States has, competitive advantage globally. But we've been exporting crude for years from my perspective, just as product.
I have a slight disagreement on that because I expect that U.S. exports of both product and crude are going to grow because the supply is going to grow, and light sweet crude should move out of the U.S. where there's a surplus, and it will. And I think the major factor is with the ban, you could have blowouts in the price relationship between WTI and Brent, and you no longer can have anything sustainable above the number that Albert gave us, which is below $3 a barrel. The ARB has to be open.
Yeah, so simplistically, we'll export everything if the market prices it. So if WTI is trading $250 to $350 under Brent, they're exporting everything they have: gasoline, diesel, fuel oil, and crude. So it's just the ARB. It's the merchants arbitraging the price differentials.
Wouldn't there be almost an automatic shut-in because of the economy and production, because there is a limit to the refining capacity?
So the question is, would there be an automatic shut-in of exports?
If refining capacity, if you will, runs at 100% in the U.S., they're exporting the crude at the differential. Because it becomes a choice question with me. Everything runs south now. It doesn't go north. So it's like it.
That would mean there was a factor shut-in of the economic production before the export ban.
Build up in storage.
Build up in storage is what happens in that. And then it's the people who can advance the commodity from crude to products.
Okay. Frank, did you?
Yeah. So,
could we get a microphone for? This is what he can do. Well, he's the only one who's allowed to use that microphone.
I can do this now. Okay, so I would go back to the balancing piece is exactly that, right? So you can go back and forth. Crude quality makes a little bit of difference, and who do you sell it to? We've been fortunate to the extent that we've had Nigeria and Libya, other light crude suppliers offline. If they come back, price discounts take a place, then you're looking at the net back in the field. So my question is, so play it forward, right? Now we're here 6 months forward from where we are. And I'm going to ask you to kind of handicap. So the OPEC decision for me, and I totally agree, that east of Suez storage has increased. Logistical storage in the United States has increased out of necessity. More storage for crude oil in the field, more in the pipelines that have been reversed, more at the refineries that are holding it, and we displaced or replaced floating storage with on-land storage. So the 5-year average, and demand's growing up, has to be higher, which means that if you're OPEC computing things 6 months ago, they're deciding that, if they thought that what is the inventory level to bring things back in balance, that should work to their advantage because the levels you need should be higher. We have a new normal. So I think where they missed the boat, right? So you thought it was coming back into balance, and this is the Goldilocks price, that on the positive side, the agreement moved prices up 90 days faster before any barrels were ever shut in. So they got the advantage of the $7, $8 price increase for 90 days times the number of barrels, pretty good for individual producer pocketbooks. What that did was people bought forward, put extra oil in storage that then got delivered in January and February and sent the price signals for other producers that now are hedging at higher levels to capitalize new investments and start drilling more wells. So best case scenario for me is that it was a test case to see how resilient the U.S. was, how much other production was out there, and how much oil could you tease out of storage. Worst case scenario is that now you exceeded the price. So we know, going back to the Adams Black-Scholes, we know $120 was too high, we know $27 was too low, something in the middle is just right, too big a middle, right? But the notion that if you're trying, they have to roll over, it seems to me, in June. If you started this situation, unless you decide now you're going to throw your hands up, go back to the market, and then prices can drop again. And then I would argue that individual members of OPEC that have spare capacity do get in a bidding war. It becomes a market share thing. And I don't know what the bottom is on that. The good side, the strategic side for that would be, if I send prices doing this for a while, it's bad for our budgets, but it's also difficult for people to borrow against future production, and maybe some of this new production doesn't come online as fast as I thought. And if I'm on a board of directors, how do I approve the deep water, remote, ultra costly production? This goes back to our gap question if you go out a few years. So just do a little speculating, crystal balling to put it in context about where we go in May and what that portends for the rest of the year.
Yeah,
I think we'll do that in 5 minutes.
I'll do it in 2. Price stability is an elusive quest. And the Goldilocks price doesn't exist for all kinds of technical reasons as well as other reasons. Technically, if you have a whole bunch of contracts with the same expiration date, it's going to create volatility because numbers are going to pass through and you'll get volatility up or down. So there is no such thing as a low volatility world, whether it's because of McNally's view of a regulator or something else. I think it's elusive, and it's the producer's best friend. So you don't want price stability, you want price volatility, and you want to embed in the market $25 swings in any given year in order to do exactly what you said, namely to defer decisions on cap spending. I don't think that a producer agreement can ever engage in a collective policy of price instability. But that's what the winning solution would be for them over time, I suspect. But yeah, going back to your core question, at least in the interim, it's almost certainly likely that there will be an extension of the agreement. How they get there is another matter. We haven't talked about Iran, Iraq, Libya, Venezuela, Nigeria, which is maybe an easier problem in fact than it is rhetorically. But I think the logic of the positions they're in makes an extension highly likely. Going beyond that, I don't think we have enough time. It'll take another hour and a half.
And since we don't have another hour and a half, Albert, you have the last
So
word.
I totally agree. You know, volatility, actually, to producer friend, because there's a finite amount of money at a price to finance the next infrastructure, build out, go drill. So we found $55 in a $4 price range for, 90 to 120 days, attracted an enormous amount of hedging activity. So when it drops $10 and then jumps back $10, it's awful hard to go back to that bank and go, give me more, or I'm more stable, because they don't like that risk profile. So volatility actually is one of the caps. The other thing I like to mention is, one of these cash and carry things we were talking about, the fear, the move to $30 and below was inland storage is full. Now, what's the price of demurrage to store in boats? There's actually people, when you talk about high-frequency traders and artificial intelligence, that overweight boat rates as a lead indicator in inventories. Well, it's like Ed's great point about like ETFs and the role. So if you think U.S. interest rates are going up and that's bad for equity and debt instruments, classically commodities are negatively correlated, and I move money into commodities. You've seen some light liquidation of the longs now, not really material. You've seen more money come in because of the negative correlation of the asset classes. That isn't going to change in the short term.
Can I please have a word on top of that?
Absolutely.
Because Albert is suggesting something that actually is unfolding, and it's been unfolding for the last 6 months. Our notion that there is a strong negative correlation between the US dollar and commodities has gone back to the original random walk, and just look what's happening on a daily basis today. Dollar's going up and commodities are going up. They don't have to move in opposite directions. The notion that that should be a positive correlation between equities and commodities, or a negative correlation between bonds and commodities, it's no longer the case. So for the last 6 months, commodities actually have become a portfolio diversifier again, and it's probably the case that that will continue with all of the other changes that are happening in the market, which should stimulate more investor interest in holding commodities.
Which means that I began with bubbles, and our conversation ends with a bubble. Please join me in giving a hand to our great...